of Deloitte as their auditor. Adani Ports could be one of the big drags today. That's in pre-open, it's down 2.5%. The bell goes and the Nifty opens at 19,380, a cut of nearly 50 points straight away, down 0.3% on both the Nifty and on the Sensex. The mid-cap index is taking a bigger cut today, with the mid-cap index down nearly 0.5%. Banks continue to come under pressure. The Nifty banking index is down close to about 0.4%, 180 points lower, with heavies like HDFC Bank, ICICI Bank under pressure, exerting pressure there with a cut of close to about 0.4%. Let's take you through some of the big movers, at least at the index level. Adani Ports is the top Nifty loser, 3.1% gone on that. And the other Adani Group company in the index, at least, Adani Enterprises, is also lower by close to about 4%. So those are the top two losers. Apart from that, you've got weakness in auto names like Eicher Motors and Tata Motors. Hindalco is weak in trade, and that's lost nearly 1.7%. IT is broadly lower. HCL Tech, TCS are currently trading with cuts of more than 0.5%. The gainers list is quite sparse. Only, I think, 4 or 5 stocks currently are making it, with some green on the screen. ONGC is the top gainer. It's a fresh 52-week high on that. As the numbers look better than what the street was anticipating, good margin performance, and the stock straight away opens with a cut of about 1.5%. ITC ahead of numbers is absolutely flat, while Divi's Laboratory is down 1.2%. Again, we are awaiting numbers from Divi's today.
Well, we move to the low point of the day, Rima, on the Nifty itself, almost at around 19,300, so keep an eye out on that front. A few gainers, though, very, very few gainers. Genius Spark continues its up move, it's up closer around 4%. Positive commentary on the con call. You had Amara Raja, that's up closer to 2.5%, so positive reaction is what we're getting in there. Box office hits over the weekend, Gadar 2, very, very good, I believe. So we have PVR Inox that's up close to 1.5%. On the flip side, many stocks are taking it on the chin. Your Vipka Laboratory is down close to around 6%. City Union Bank is down close to around 5%. Muthoot Finance down another 5%. Nalco, the numbers were weak, that's down close to around 3%. And JSPL, we said the numbers were good. The only problem with the numbers was the street seems to have sensed that. And there was pre-buying on Friday's trading session. The stock ended at the high point of the day. And that one is coming for profit taking down close to around 2.5% or thereabouts. India Cements as well down close to around 3%. Big volumes in early trade. Voltas, well, that's pulled back close to around 2% as well. Yes, market share gains come about, but still those numbers are a little lower than what the street was working with. Prashant, what else?
Well, it's a full 100-point cut now. So, 19,310 is where we are at on the Nifty. And maybe just take a quick look at the other indices as well as we start. The Nifty Bank should come up. That's down about 0.6%. So that's sort of falling in line with what the Nifty is doing. Mid-cap index will come up on your screen. That's down a full 1%. And the small-cap index is the last one, which is down about 1% as well. So across the board, there is pressure which is emerging. Just a few more names. Look at Astral. I was highlighting that earlier. I think there's a CLSA downgrade. Numbers, by the way, are not bad. Numbers are in line for the first quarter. Stocks down about 3%. So keep an eye out on that one. Info Edge, I think we highlighted that. That is down this morning with 3.5% cut the last I checked. Muthoot is a sharp cut, right? I mean, numbers, again, I think the problem is spreads. And we'll talk more about that one. But the stock from 1,000 rupees, where it was languishing, had come up nicely. Patanjali is the other one, which is around about 4% or so, with a steep cut this morning. IRFC, I think we highlighted. IRFC, but they've got the largest volumes this morning. Huge in terms of volumes. It's down 4% as well. So that's the losers list with at least what's got volumes in it. Genus is racing ahead. Full 7% pop. For the longest time, after they announced that deal with the GIC, stock kind of was stuck at that 190 odd rupee levels, but that's taken it out, and we're running up on this one. So that is Genus for you, doing well. And there is Cochin Shipyard, which is up 3.25%. Garden Reach was with us. The management was with us 15 minutes back. That is up about 4%. So reacting to earnings and a decent commentary. And there is something like a rate gain, which continues its up move. Rate gain numbers were super solid, and that's kindly sidestepped any correction that the broader market has seen over the last couple of days. Look at KDDL, right? That's the Kamla Dials. Ethos was having a very strong move towards the end of last week, and Ethos numbers were strong. KDDL this morning is up 12%. 2065. It should come up on your screens. And it's got decent sized volumes for this point of the day. That's KDDL. We'll try and have that up for you in a bit.
Nika, let's just quickly pull up Nika. It's down 10% right now. Numbers were pretty okay. The BPC segment, the beauty segment has done well, but the fashion segment hasn't performed as per the market expectations and even the company expectations on account of competition. Remember, there's also been the launch of a competitor platform by a competitor with deep pockets, and that's also hurt. And Nika has gotten hit quite hard. And another one, NetWeb Technologies. It's the first results for the company post-listing, and it had seen bumper listing, very strong subscription, but the stock is down 5.5% in trade. The numbers are weak. Both quarter-on-quarter, year-on-year revenues have declined.
No, absolutely. So here's some very sharp moves coming through. I was referring to KDDL. I mean, I don't know if you can pull the stock up. It should come up on your screen. So that's a decent mover, 12% higher on decent volumes. Vetri Subramaniam is with us, Chief Investment Officer at UTI AMC. Vetri, great to have you with us here. Good morning. Thanks for your time. How are we looking in the near term? And then, I mean, beyond that, do you think we are at the cusp of a bit of a sell-off in what has been a pretty good bull market and perhaps remains so?
Morning, Prashant. Good to be here. I don't have much of a view on that, Prashant. Don't really trade the market looking at such short-term moves. We are sort of focused more on the longer-term moves in the market and construct portfolios based on that. We tell our investors to think long-term, and that's exactly how we tend to behave ourselves. So we don't try and chase the market in terms of short-term moves over weeks or days.
That's perfectly fine. But do you have a view, Vetri? I mean, in terms of broadly, is it a time to sort of dip in aggressively? Is it time to pare back? Just a broad kind of view.
Sure. No. Yeah, let me sort of fill you in on that. So, internally we do run some asset allocation models which feed into our advantage and multi-asset strategies. And this is really a composite of valuations that we are looking at to determine how attractive equities look at every point of time. And that sort of stuck, I would say, somewhere between neutral to expensive. So to put it in perspective, Prashant, if we find equities really unattractive, the model can drop allocation all the way down to 30%. And if we find valuations hugely attractive, it can raise the allocation all the way up to 90%. It's pretty much stuck right in the middle right now at about 60%. And, when I look at particularly the mid and small cap segments of the market, there's some element of them actually being slightly richer than even the Nifty, which is the primary model that we look at. So I would say, this is a time to sort of manage your risk, stagger your investments. And if you're choosing to make large investments in the market, then, you're sort of in that neutral zone as far as valuations are concerned.
Vetri, morning. What's the best way to manage your risks? You said that the valuations in small caps is slightly on the higher side. Would you reduce your allocation to small caps? Which would be the themes that you would bet on where you're still comfortable with the risk reward?
Sure. I think from a market cap point of view, Rima, we'd be most comfortable with the large caps, followed by the mid caps, and least comfortable with the small caps. Having said that, I should say that this was my view even 3 months ago, and I'm surprised by the strength that we've seen in small caps during this period. But to my mind, not just the valuations, but also looking at the macro environment where, rates look like they're going to be higher for longer in India. Certainly that's the case globally. Global growth, certainly the US proving to be quite resilient, but it's not like global growth is gangbusters, so we haven't really got positive sort of tailwinds kicking in from there. It's not a great macroeconomic environment from my point of view for the mid and small cap parts of the market. So large caps is where we have the maximum comfort. I think from our point of view, one of the more contrarian calls we had was more sector rather than market cap, which is the pharmaceutical space. Again, that's been something that I liked even in 22. It didn't do much, but in this year, finally, it's sort of starting to show some good performance, and that would continue to be an area or a sector that we would back with sort of valuations in favor. And I think, still sort of contrarian positioning over there.
Hi, Vetri. Good morning. Well, as we speak, the Nifty is at its lowest levels we have seen since, I think, the 4th of July. A bit of selling is what we are seeing creeping in there. Well, Vetri, you get the point. US economy is actually looking solid, more solid than what most were expecting, and you're sounding a little bit cautious on the broader markets. But in a couple of aspects, Timken India, they have put it on the exchanges that demand is a little bit slower. And after a while, we are hearing things like this. Will you be, do you think the Indian economy as well in the near could be in for some softness? Premiumization, yes, that's picking up, but there are pockets which are still in pain. Your view on it?
No, certainly, Nigel. I think, I'm sure, and I don't want to go back to the K-shaped recovery. That's certainly been something which is visible when we look at the data of companies. There's a big divergence in terms of the kind of income class to which companies are selling their products. Those selling to upper and higher income categories have actually done far better than those selling to the lower end. I think as far as growth is concerned, I would just say that, look, we've come out of this pandemic period in really good shape relative to other parts of the world, but it puts us on trajectory for maybe 6% GDP growth, give and take a little bit here based on how global tailwinds and headwinds sort of pan out. It's not like growth is like off to the races. And I think when you look at the commentary that's coming out of the MPC, which is essentially saying that, we are concerned about inflation. We don't really see any rate cuts on the horizon. We are going to continue to persist with, withdrawal of accommodation. You get a sense that, we are in a reasonably good place, but not like we are off to the races. So that, to my mind, is a little bit of a challenge when you talk about, having very elevated growth expectations. And I think the other factor, which perhaps in global markets we will need to sort of pay some attention to, is while the US has certainly surprised in terms of the strength of the economy, China is proving to be a particularly significant pain point at this point, not just in terms of growth, but also in terms of the fact that it's now starting to export deflation. Not a bad thing given that everybody is concerned about inflation, but it has longer term ramifications.
Yeah, no, absolutely. I put out a piece on Friday on China, and with a slightly longer term, it's kind of headed Japan's way from 30 years ago when we had a very prolonged kind of downturn. But that's, one for the long term. Vetri, so you said large cap orientation, right? So what happens is one gets to get carried away and kind of, because the most money has been made in small caps. So I'm assuming that, and we've not had this downturn for a while. It's just 140 points right now, but we've not even had that. The small cap index is down 1.5%. And I think you can count the number of days the small cap index has been down more than 1% since the rally started from late March. So if for those who are heavily into this part of the market and are watching this, the natural impulse which kicks in, well, it'll be okay. So you think they should actively kind of look at moving investments into large caps, that kind of thing? Your advice?
Sure. Again, I can't give a one-size-fits-all prescription to everybody out there. But from a valuation standpoint, I do think, the small caps give me the least comfort. I also think, Prashant, we've got to be a little bit careful, when we look at year-to-date data, or even if you look at 3-year data, you're picking up a very favorable base point in terms of the returns from small caps. If I just shift the horizon to, let's say, 5 years or 7 years, things will suddenly start to look very different. In our sort of modeling, when we look at the data on a rolling basis over much longer time periods, actually the most attractive segment of the market over the mid to longer term tends to be the mid caps, which not only gives you better returns than large caps, but is also superior on a risk adjusted basis. Actually, this is not true of small caps. Now, there could be some individual small cap funds which do well, but when you look at the small cap index, its risk adjusted returns are actually not very great. So to my mind, that will continue to be a little bit of a cautionary note as far as small caps are concerned. And historical experience, been in the market for 30 years now, every time you see the economy go through a little bit of pain, the companies which are most vulnerable to that tend to be the mid caps, rather tend to be the small caps. So that's where I would sort of raise that flag of caution. I don't know individual people's allocations number, but certainly given the valuations, I would take some money off small caps and move it to large caps.
Always good hearing your thoughts, Vetri. Thanks so much for stopping by and filling us in with your commentary. So not a bad idea, I think, to be a little bit cautious and maybe finding more comfort in large caps in comparison to the smaller cap names. Well, let's move on then. Astral, that's a stock on our radar for quarter one. Their revenue has come in line, but margins have contracted a little bit. Realizations as well a little bit lower than, say, Supreme Industries. What is your market share?
So first quarter, the volume growth was 31%, which was a very, very robust. Secondly, we should also understand that the Astral is predominantly a plumbing company. The sizable volume which is coming in the market to the other competitor, that is mainly from the agricultural business, where the Astral presence is very, very low. So that is the reason compared to other, you feel that is otherwise in a plumbing side, I think we are perhaps the having highest volume right now in the industry. So volumes were very, very healthy. And you rightly said that the top line was low because of the polymer effect. Now the polymer have started inching up. So in the coming quarter, you will see slowly and gradually the value growth will come back. Margins were also very, very decent, I can say. If you compare with any of our peers, we were the highest in the industry. So margin front also, we are very, very happy with the performance. And in the coming time also, the way volume have started coming back, we are seeing that in the coming quarter, volume can be very, very robust because the way the year has started and the way this current quarter also, first almost 40 days, we have crossed 40, 45 days. The numbers are moving in the same direction what we have seen in the Q1. So I think we are very, very excited with the performance of the company.
Thanks, Mr. Sablani, for giving us that clarification, because in your core business, you're not losing market share. In fact, you're seeing the volume growth is as much. So we get that. But for the year, what kind of a volume growth are you targeting? You stick to mid-teens, or since quarter one has been good, the first 40 days of quarter two has been fairly good, you want to revise that number upwards? What should the range be, volume growth?
So I think we have given the guidance of 15% on a full year basis, but the way numbers are moving for the first, I think, quarter and the first 45 days of current, I think it should be much, much higher. But keep finger crossed. Once we will be completing Q2, we will be revising upward our guidance.
So Q2 so far, Mr. Sablani has been running at 30%? Same run rate?
Yes, 30% plus.
Okay, so it'll be, and you said at the end of Q2, you will revise your guidance upwards.
Yes, yes.
Okay. It should be at least a 5 percentage point increase, right? If not more.
Let me complete the Q2. I think it will be a surprise to the market.
Okay. Mr. Sablani, could you talk to us a little bit about margins and how they are likely to pan out? What's the guidance there?
I think margin we already given 16 to 18% zone, and we are on the upper end right now. So I don't see any problem. In spite of lower polymer price was there, we have maintained our margin. So coming time when our main seasonal business quarters will start from October onward, I think there the contribution of value-added product is always high. If you see the history of last 10, 15 years, contribution from our main core product CPVC and the value-added product is always high. You see the Q4 number also, our margins were 20% plus. So I think in the coming time, we are seeing that once the value-added product contribution will start in the coming quarter, margin can even improve from here.
What's the contribution of the value-added products? And by when do you expect it to significantly scale up? And what would be the long-term margins? Currently, for this year, 16 to 18% is your margin guidance. But can you just stretch the horizon a bit and tell us what would your aspiration be?
So we have given the long-term guidance only 16 to 18% because the polymer is always highly volatile. So in that environment, giving a higher guidance, it is always a painful. So we don't want to unnecessarily create a grapevine in the market or unnecessarily misguide any of the investors. That's why we are always conservatively giving guidance. But yes, definitely we will try our best. If you see the history of last 3-4 years, we are always on the higher end. So we will try our best to fetch higher margin. But this will be the broader range. That is what we have given the guidance.
Okay, all right. Well, Mr. Sablani, by your own admission, selling of bathware as well as faucetware is a little tougher, right, than selling pipes. How do you see the sanitary ware as well as faucet business shaping up? What could the revenue potential be? For this year, what is the target? And going ahead, how do you see this business scaling up?
So any new vertical is always tough. It's
Indeed.
nothing easy in the business. So definitely it is a tough. But I think the way brand is there, the way Astral brand is strong in the market, we are quite confident that this segment will also give us a good number. I think in the very first year, we have still not completed 1 year. We have crossed the 5 crore run rate for the last 3 months. So I think it is shaping up very well. We have created more than 500 showrooms plus touch point in India, and another few are under pipeline. So I think we are going in the right direction. We don't want to unnecessarily jump in a fast volume growth, and then there is the problem. So we are going very, very steadily, and after understanding the market, we are moving in the right direction. So I think once the project business will start coming to the system, I think volume will shoot up there also. I think it will take another 12 months time to pick up the volume, but we are confident that slowly and gradually we will take this business also to the new scale.
So currently you're doing 15 crores per quarter, right? In terms of revenues?
Yeah. Yes.
And so say in the next few quarters, how do you see this number scaling up on a quarterly run rate? What should it look like?
So I think every quarter, next 6-7 quarter, every quarter you will see there will be improvement.
Mr. Savlani, I think you said this business, the new business will contribute 1,500 crores in the medium term. I think that's the number that you put out.
Yeah, for 5 years, next 5 years.
Over the next 5 years. Okay, and much higher margin business here, right?
So initially not, because initially the scale will not be there.
Of course.
So margins will not be that equivalent to our current business. But once they will reach at a certain scale, then definitely it will be contributing higher.
All right.
Just one final question. So you've incurred an inventory loss in the current quarter of, I think, 15-17 crore. There's, thereabout. Is this something which will persist?
I don't think so. It will be there because now the polymer prices have started going up. If it will further go up, it can be inventory gain also in the coming quarter.
Okay. All right. Mr. Savlani, you have a capex, I think, of around 350 crores for this year. For next year as well, you have around 250 crores. And you have expansions, in various units, whether it's Guwahati, Hyderabad, Kanpur as well. I think your current capacity is around 290,000 odd. Given by, going by what you're doing in your core business as well as the diversification, the sanitary ware as well as faucet business, where do you see your revenue potential, the peak potential? Give us a 3-year time horizon. How do you see this ramping up? As of last year, well, your revenues were around 5,200 crores ballpark, with 18 to 16% margins on. So how do you see the revenue scale up? In 3 years, where should it be?
So I think we have given a guidance for next 5 years for 15% CAGR, and we are standby with that guidance. But the way demand is shooting up in the piping sector, I think I'm very, very excited. And that is the reason you see in the history, Astral has never ever done an announcement of 3 plants at a time. So this is the first time that we are putting up 3 plants at a time. And that is what showing the confidence of the management. The coming time, we are expecting the pipe business to do really good for our organization. And the number can be upward direction also. But because once this plant will be commissioned, then only we will be capturing the new geographies. And then we will be taking the market share in that particular geography. So keep finger crossed. Once this expansion activity will get over, we are very, very excited right now to come as early as possible, because we have already allocated the sizable, I think, money to our other businesses. So now new capital is not going to be contributed to our other businesses. Maximum contribution will go to the pipe. There we are seeing a very, very robust demand, and we are continuously getting the market share, which you can see for last 3-4 years number. And we are very confident that in coming time also we will gain further market share in next 2 to 3 years time.
So we're going at 15% CAGR, say in the next 5 years, I mean, say by 2027, 28, revenue should be at 10,500 crores approximately, just going by that calculation?
Hypothetically, 15% CAGR means every 5 years you are doubling your revenue. So naturally 10,000 crores.
And you don't have to put any more capex for that?
I think normal capex will be there, will not be a substantially high capex, and we company sitting with sizable cash, so that is not a problem to the organization. We are a debt-free company.
Got it.
Thank you, Mr. Savlani, for joining in. Wish you all the very best. Let's move on. Apollo Hospitals has reported a mixed set of Q1 numbers. Revenues and margins have come in line with street expectations. In the conference call, the management has said that lower discounts has impacted the top line in their 24/7 business. Sunita Reddy, the managing director at Apollo Hospitals, is now with us on the show. Ms. Reddy, morning, and thank you very much for joining in. Let me get to your omni-channel arm, Apollo 24/7. On a quarter-on-quarter basis, I believe the losses have come down. Can you give us some guidance on reducing the cash burn? When will you, achieve operational break even, and by how much have the discounts come down by?
So if you look at, the company has grown very well. Apollo Healthco has registered 1,805 crores of revenue, which is a growth of 22%. However, the losses were at 83 crores, which is down from last year when it was 89 crores. Going forward, yes, the company has reduced discounts. Discounts have come down from 18 to 15%, and this has resulted in a lower cash burn. Being an omni-channel play, the offline has done extremely well. They have grown by 22%, and this has really contributed to cash flows. Going forward, I think the company is well poised to reach a EBITDA break-even in Q4 and achieve 3,000 crores of GMV.
Hi, good morning.
Morning.
Could you tell us how much have online discounts reduced in the pharmacy space, and what's been the implication for growth there, revenues?
I think the best way to do this is to deconstruct the revenues. So offline and the offline EBITDA came in at 125 crores, which is really a growth of 13%. And there was a cash loss on online of 57 crores, which resulted in a negative 83 crores. So discounting, as like I said earlier, has come down from 18 to 15%. And there was also cost rationalization and focus on profitability that has yielded this quarter's set of numbers. But they are on track to achieve 3,000 crores of GMV.
I remember you had said that last quarter as well, that the omni-channel business will achieve operational break even in Q4 of FY24, and you're sticking by it, Ms. Reddy. Just one more question on this subject, and then we'll move on to the other businesses, hospitals. You had fundraising plans. You were looking to raise money for the omni-channel play. Could you give us an update on that?
So currently we are in a very healthy state with the offline generating enough cash for the business. However, like I said earlier, we have we have opportunities to raise capital, but this should not be at a discount to the actual value, and this should really maximize shareholder value. So we will look at this opportunity in September again, but currently the company is very well funded for growth and to achieve its targets.
All right. Hi, good morning, Ms. Reddy. Well, give us a couple of more numbers then. How do you see occupancy shape up from here on? And also your average revenue per hospital bed, if you could tell us, how is that number as well moving?
So we were at 62% occupancy. Going forward, we are on track to reach 68% by the end of the year. What is improving is our payer mix. So if you look at 82% of our payer mix now comes from insurance and cash. This has grown by a healthy 11%, and this has contributed to a volume growth of 6%. Currently, international patients are at 6% of total revenue, and this has grown by 34% over last year. So going forward, we are looking at a healthy occupancy of 68% with this payer mix. And this is what has contributed to our ARPOB is clearly the fact that our centers of excellence, our Congo specialties have contributed to 63% of our revenue, and therefore with the higher intensity of case mix and this payer mix, our ARPOB has gone to 57,704.
Ma'am, could you talk to us a little bit about margins because they're blended margins overall. So cost pressures seem to have emerged across segments. I mean, hospitals, Apollo Health and Lifestyle. Could you guide us on what blended margins could look like going ahead, FY24?
So I think, the healthcare services business has registered good margins, and there is a scope to improve these margins by 100 basis points. Currently, we're at 23.6, and we're looking at, ending the year with close to 25. Apollo Health and Lifestyle has added a diagnostic network, which has contributed to cost, and therefore, but they are registering revenues of 100 crores per quarter, and in line with our projections for 500 crores for the year. This is the network addition cost. Plus, we had some one-time cost this year of Apollo Health and Lifestyle had a one-time cost of 15 crores, which is why it looked like the costs have increased. In the healthcare space, yes, we did have additional costs. Bringing on doctors at guarantee money and employee cost has increased, but we do believe that by the end of the year, costs will come down.
And for the diagnostic business, you're saying your guidance is for 500 crores of revenues for this year versus about 100 that you've done in the current quarter. Can you just getting back? Yes. Can you just getting back to the hospitals business? You told us the occupancy target, I think 68%. The average revenue per occupied bed, as you pointed out, is 57,500 plus or minus. It's gone up by 11% on a year-on-year basis. What led to that? And what is the guidance on the average revenue per bed? I remember in some interaction before you had even spoken about 60,000.
Yes, clearly there is an opportunity to grow to 60,000. I think I answered that earlier when I said that our payer mix had changed with insurance and cash coming in at over 82% and international patients at 6%. And therefore, this has resulted in a higher RPOB. This in line with surgical volumes going up by 60. Currently at 63% of total revenue has contributed to this RPOB of 57,700 rupees. Going forward, I think, with this focus, we should be able to continuously, next year, probably grow the RPOB by another 6%. But volume growth is where our focus is.
All right, Ms. Reddy, thanks so much for stopping by and filling us in with all those details. Wishing you all the best for the remainder of this fiscal, and we're looking forward to chatting up with you rather soon. For the time being, though, we'll slip into a short break. On the other side, we'll connect with the management of Nifty Organics to discuss their past quarter's numbers and the outlook as well. Stay with us. Welcome back. You're tuned in to Bazaar Morning Call here on CNBC-TV18. Well, Nifty Organics, they came out with their set of numbers. And more than the past quarter, I think the street wants to understand what's the way ahead on the demand front. To help us out with that, we're joined by Viniti Saraf-Mudrija, the Managing Director at Nifty Organics. Hi, Viniti. Morning. Thanks so much for joining in. Well, there was some bit of weakness that we saw in the past quarter. Can you explain what's happening across segments? Well, you get most of your revenues, as we understand, from the exports markets. So what's the demand situation like first up? And has quarter two started off on a better note? Is it looking better than quarter one?
Sure. Good morning. Globally, most chemical companies have announced a soft year going ahead. And 60-70% of our sales are dependent on exports coming from North America and Western Europe. And we are seeing a slowdown in those geographies starting, I would say, March March onwards. In fact, we were well aware in March itself that for the next 6 months, most of our major customers would be destocking high inventory levels. Actually, what had happened last year, if you see in Q3 and Q4, most customers had purchased too much product, in fact, more than we had anticipated. And hence, the second half of last year was very good. But in the beginning of this year, they realized they're sitting on too much inventory. Maybe they were scared because of COVID and high freight costs, which has all come down and everything is normalized. Q2 looks, it will be similar to Q1. This destocking will continue up to September, October. I expect recovery in most of our product segments starting October onwards.
Amongst your three segments, which one has seen the most pressure? Could you just provide a little more color on that?
Yeah, absolutely. ATBS was the highest performer last year, especially in second half. And that is, in fact, seeing the biggest degrowth also and the biggest destocking effect in the last 4 months and also going ahead for the next 2 months. IBB remains stable business. So do our other niche products. Butyl phenols, in fact, we are seeing a slight growth starting now. We are able to penetrate better into the market.
Vinity, hi, good morning. One is destocking because people bought too much. And you say that'll continue, perhaps will normalize only by October. What about pricing? Vinity, if you can talk to us a little bit about that. How is that likely to pan out, next 2 quarters?
Actually, incidentally for us, pricing hasn't had a big impact. I know most raw materials are falling, but for us, while some have fallen, some have also remained same, such as MTB, which is our biggest raw material from which we make IB. So prices have remained more or less stable. It's the volume that has dropped. I see similar trends in Q2. Butyl phenols, there's some softening in pricing, but not in other segments like IBP, etc.
All right, Vinity, when do you expect the merger of Viral and Vinity to be done by? If you could give us a broad timeline out there. And also at peak, butyl phenol will contribute, I think, around 700 crores, right? When does it start showing up in your books?
Sure. I think for the merger, we should ask that question to NCLT. We've gotten the shareholders' approval, the lenders' approval. It's just been pending for the last approval from NCLT. It's really up to the courts when they take up our hearing. What was your next question on butyl phenols?
Butyl phenols.
Yeah, this year we will do about 200 to 300 crores in revenue. Full potential is about 400 to 500 crores, yes.
I think last time you had indicated that FY24 revenues will be flattish. Considering in Q1 the top line has degrown, Q2 is also going to be weak. What can you guide for the full year now?
Sure. I think the revenues still, I would maintain, we can maintain last year's revenues given two things. The degrowth in ATBS will be compensated by the growth in butyl phenols, as well as if the merger goes through, which I hope it should in the next quarter at least, then we will see about 150 to 200 crores revenues coming from antioxidants. So given all that, we expect to maintain about 2,000 crores in revenues this year as well.
All right, Vinity, since things are quite uncertain, have you revised your CAPEX plans or are you sticking to what you had laid out earlier?
CAPEX remains as it is because that's a long-term view. Our long-term view still remains positive. In fact, even as far as ATBS is concerned, we are going ahead with the new line, which is expected to come on stream next year by March, April. The new products that we are getting into the anisole derivatives, MEHQ, that's on track as well. Wakefall, also isoamylene derivatives, so no change in CAPEX.
CAPEX earlier was what, 580 crores, right? And 240 has been spent.
Sorry, please repeat that.
The total CAPEX, Vinity, for the year, I think that was drawn out was approximately 600 crores, 580, 600 crores?
That's right. That's spread over 18 months, but about 40% of that has been spent. The most of the expenditure happens towards the end of the CAPEX cycle.
Yeah. Vinity, sorry, just one last question from my side. Slightly macro-ish. I don't know if that has implications. We got numbers. We're getting very dire economic numbers out of China over the last 2 weeks or so. all outright deflationary kind of situation, at least for now. If that were to continue, I mean, what does it mean for raw material prices generally? You said things are steady for now because it got balanced. Some fell, some did not fall, etc. But do you think it's going to be a big factor over the next for the foreseeable future?
See, generally now what I have heard is because of China dumping, a lot of prices are falling. We do see that in some segments, China economy itself hasn't recovered, as the demand in China is slow. So they are dumping across geographies. I'm really not an expert because the China effect has less effect on our business as such. Because we compete less with them, and also we are in niche products where we have contracts in place.
Okay, all right. So that's why the Vinity Organic stock is also treated differently. I mean, you're up on the specialty curve, and
the margins we have more or less been able to maintain. If you compare the margins year on year, they haven't changed significantly.
Yeah, absolutely. All right, we'll leave it there. Vinity, great to speak with you. Appreciate you joining in. And thanks very much for taking the time speaking with us here on CNBC-TV18. Well, let's take okay, Mitesh and Sudarshan are back with us for a quick run on things. Mitesh is with us, actually. We're down 100 points. There is some recovery from the day's low which has come in. Mitesh, how would you look at things and what would you want to put out as a new trade?
Prashant, first a word on the index. 19,200 is what I was highlighting as the support area. Kind of, nearly being there, 19,257 being the low. I think around these levels, you will see some, positive traction come, some demand happen, and some short covering could happen. But a lot of stocks with this movement are breaking down. So I think, we actually, while on the index, I would advocate taking some profits on the short positions. On the stock side, is still looking at stocks, which could possibly give a correction or a pullback. So on the list is Ultratech Cement. I think today it made a low of 80.50. If it breaks 80.45, go short here with the stop at 8100. And a target of around 7,900 can be looked at. And on the long side is Trent. After the numbers, the stock had bounced back very nicely. And then on Friday and today, I think some kind of pullback is going on. So buy here with a stop below day's low of 1860 for targets of 1930. A disclaimer, we have recommended both the stock to our clients and have positions in the option segment. So there's vested interest in both these stocks.
Okay, all right. Thanks a lot for that, Mitesh. Well, the markets are still down. We're down close to under 120 points. But, if my director can pull up, Infosys and Reliance Industries, they seem to be trying to put in a bit of a fight. And that's why we've recovered close to around 40 points from the day's low. Just take a look at the intraday chart out there. Both of them, they're putting their hand up and trying to be counted. The problem is the Nifty Bank continues to see weakness. It's down 350 points out. Well, time to focus on a couple of stocks that are moving around. Abhishek's back with us to tell us about Muthoot Finance. Abhishek.
Well, the AUM growth for Muthoot Finance was strong at around 19% YOY, which is perhaps one of the best in last 8 quarters, and 7% sequentially. The gold AUM growth is also strong at 17.5% YOY and about 6.7% sequentially. Calculation shows that the average ticket size might have increased by about 12% YOY and 5% sequentially. The net interest margin has dipped a bit to 11.58% when compared to 12.26% in the previous quarter, and home finance subsidiary that saw sharp consumption of capital adequacy ratio is down to 52% when compared to 66% in the previous quarter. Belstar MFI, the AUM growth is strong over there, 49% growth YOY and about 13% sequentially. However, we have a downgrade coming in from Morgan Stanley. They have downgraded Muthoot Finance to underweight from equal weight. Target price has been cut to 1,150 per share. They say that the gold price rise has driven the Muthoot's loan growth this time around. Stock now appears to be consolidating. Structural risk is there to gold loan growth, and yields from competition remain. So they have reduced FY24 to 26 consolidated net interest margin to about 11.7% when compared to 12.3% that they had earlier. And they have also cut down the standalone EPS estimate over the next 3 years anywhere between 3.6% to as high as 6.6%. Back to you.
Okay, thank you very much for that. Nika is the other one on our radar. Mangalam joins in. Mangalam?
Well, Nykaa's down 8%, and here's 5 reasons why. The first one, in their first quarter numbers, it was the weakness that in the fashion business, gross merchandise value, that's impacted their overall performance. So the overall GMV in the first quarter was up 24%, but the fashion business saw a growth of just around 12% year on year, and quarter on quarter there was a decline of 1.5%. That's not all. The contribution margins of the fashion business also declined by about 50 basis points as the company upped their marketing spends. The second reason, lower ad revenue. The company got lower ad revenue on its platform. There was a pullback in ad spends coming in from all the D2C players because of a funding winter coming in. The third reason, eB2B business, which is their superstore business, saw an impact of nearly 90 basis points on the gross margins because of the product mix. Fourth reason was brokerage downgrade. So Nomura, for instance, has downgraded the stock to neutral, cut the target price at around to 163 rupees per share as well. And the fifth reason, valuations. The stock hasn't done much in the last 1 year or so from a point-to-point basis, but still trades at around 4.5 times 2-year forward price to sales. So that is something that perhaps the street is not very comfortable with.
Okay, Mangalam, nicely and neatly summarized. Thanks very much. That's Nykaa in focus. ABB is the next one. Vivek has got details. Vivek.
Well, ABB India clearly appears to be a case of, the stock actually selling off on good numbers. If you're comparing the numbers versus the consolidated estimates as well as our own estimates, our numbers were a clear beat. Even the order inflow, in fact, the only sore point would be the fact that the company's base orders grew only around 4%. The order book growth was higher this time around, largely aided by a one-time, the order that the company received from a large metal company. But if you're looking at the numbers themselves, double-digit profitability as well as revenue growth. Revenues higher by almost 22% on a year-on-year basis, in line with the estimates. Strong operational performance, so EBITDA margins coming in at 13.9% versus 12% this time around. Profitability higher, against a pool of 247 crore, coming in at close to 295 crore. When you're talking about the core order book, standing in at this time around, standing in above 7,700 crore. However, Kotak Institutional Equities has gone ahead and downgraded the stock. What they're saying at this point of time, despite good Q1, the valuation at this point of time is not giving a comfort, which is what is driving the downgrade at this point of time.
Okay, all right, Vivek, thanks very much for that. So that's ABB down despite decent numbers. We'll take a quick commercial break here. We have Saurabh Mashruwala, Chief Financial Officer at Torrent Power, who will be joining in for a quick discussion on their first quarter numbers. Stay tuned.
Welcome back. The Nifty is now above 19,300. It's been a recovery of close to about 70 points from the day's low. And one important support level to track will be the 20-day moving average on the Nifty. We got quite close to it. 19,240 is the, 50-day moving average. 50-day moving average is 19,240. The markets went close to it, but from there it's rebounded, aided by Reliance and Infosys. But let's talk commodities. Manisha is with us. Manisha.
Thank you so much for that. I'm looking at the gold prices today, which are trading at around 1 month lows. We have seen 3 weeks of constant decline coming in for the gold prices. And the weakness comes in on the back of strength in US dollar, which has seen an uptrend for the last 4 weeks. You also have seen strong treasury yields. The markets also are dealing with high inflation numbers that we saw come in from US, and all of that is weighing onto the markets. I want to tell you on what we've done on a week-on-week and a month-on-month basis. So in the last 1 week, the gold prices have declined by nearly 1.5%, while silver prices fell by 2.5% in the same time. In the last 1 month as well, both the commodities have posted negative returns, with gold down 2.5% and silver down 10% as well. And now when you look at the volatility that we have seen in case of gold prices for the year, we started this year with 1823. We did see 1810 of a low by the month of Feb, and then we saw a high of 2051 by the month of May, and currently trading at 1910, with the street anticipating if we continue to see higher inflation, another rate hike from US, then you perhaps are looking at 1900 breaching on the lower side as well. So while the returns in the very near term may not have done well for you, but the markets definitely seem to be buying into these declines. For the first half of this year, we've seen global central banks go on a rampage. This is the highest record ever in the first half of a year that you have seen this kind of a buying come in from central banks at around nearly 357 tons. Last year was a record buying as well at 1136 tons by the global central banks. So whether it has been about Russia, China, Turkey, Kazakhstan, many European countries, even India for that matter, we have seen our buying increase as well. And as of now, our gold reserves hold 8.17% of its total at 797 tons. So India has been buying gold as well. And you look at the gold ETF buying within India, and June and July have been very strong months. It has been net flows of inflows of around 456 crores as compared to 70 crores last month. So on a month-on-month basis, we have seen a very strong jump, and this is only because the gold prices have corrected slightly on the weaker side there. But this is going to be a data-heavy week yet again. In this week itself, we are looking from industrial production, retail sales to housing numbers coming in from China and from US as well. You will be watching out for the retail sales numbers. It also is going to be about the US Fed minutes this week as well, and that's what will give further cues for the market.
All right, Manisha, thanks very much for that. So that is the commodity picture. Well, you know, I saw that flash on PVR Inox, highest ever weekend collections. So that is quite something. I mean,
Going for a movie today?
I don't know. You're trying to? Which one, Gadar?
Yeah. I've not even seen the Rocky and Rani. I'm Bollywood, so I'm keen.
You know, it's kind of it boggles my mind that Gadar, the first one, came out in 2001.
Yeah.
Wow.
You know? It's been so long. It just seems, it doesn't seem like that. I thought, well, it must be 10 years, 50. And I love that movie. And the second one, of course, I mean, which is now out, which is, I guess, responsible for this blockbuster collections. Yeah. I mean, incredible. And I read somewhere that Sunny Deol is now closer to 65 plus. I mean, I don't know the exact age, but that's incredible.
Still the macho man in him. And you know, what about in North India? Parts of North India, they're going to watch the movie on the tractor. Amazing. Now, you can't beat Punjabis. I just love that.
All right, well, we'll take a quick commercial break. Do we take that break? No, we don't take that break. We have a very special conversation now lined up. Torrent Power Management is with us. I mean, you rarely, very few times you see them on television. This is one of those times. The company reported a steady set of the first quarter numbers. Revenues and EBITDA witnessed good growth, while margins were stable at 16%. Saurabh Mashruwala is Chief Financial Officer at Torrent Power. He's joining us to take some questions. Saurabh, great to have you with us here. Appreciate your time here on CNBC-TV18. Prashant this side. You know, I just want to start with just a quick comment, and I want to ask you to comment on each of these things. So you had your distribution business, which was flat in the quarter which went by. On the renewable side, numbers were a little subdued. I was reading that maybe that cyclone did some damage. The thermal numbers were strong, but that was largely on the back of merchant sales. So just a quick comment, one line each on each of these segments, and how do you see them panning out as we go ahead? Go on.
As far as distribution is concerned, yes, you are right. Is that it's a stable business. In fact, we have two categories of distribution business. One is license business and one is franchise business. License business is a more or less stable business. We earn the regular returns as well as efficiency gain. And franchise business, yes, it's a non-regulated business. So we make profit out of the volumes gains as well as reduction in AT&C losses. So historically, we have a good track record of improving the AT&C losses across all our distribution business. So if you look at our license distribution business, our AT&C loss is sub 4%. This is remarkable, I would say, compared to global benchmark. And as far as franchise distribution business is concerned, Agra and Bhiwandi are difficult territories. We are able to turn around them, and our AT&C loss is sub 10%, I would say, and which was about more than 50% when we took it over in long back, I would say. In terms of our new acquisitions, SMK, Seal, Bumrah, and Kalwa, we are able to reduce the distribution losses, AT&C losses, from 55% when we took it over about 3 years before to about 33%. So we have a remarkable show in terms of reduction in distribution losses across all our distribution segments. So which is one of the contributors, I would say, for the current quarter. Apart from that, we have a thermal generation where in the current quarter, we are able to participate in the government scheme for supplying power for the gas from the gas-based power project, which has contributed about 145 crores, I would say, from the sale of LNG trading as well as sale of merchant power, which was about 80 crores last year, a similar quarter. So that has also contributed significantly in our bottom line for the current quarter. In terms of renewables, yes, renewables, we are growing. Opportunity is pretty large as the government has a target to achieve our 500 gigawatt of renewable capacity by 2030. So it's a very large opportunity for all the players in the industry. And so we are also very active in the renewable segments also. We have about a 2 gigawatt of renewable capacity operational as well as the construction capacity. We are very recently ventured into the C&I segment, which is very promising segment, where C&I consume about 50% of the electricity in India, and RE penetration for these renewable segment is less than 5%. So it presents a very good opportunity for us. So we are actively considering that segment also. We have about 165 megawatt of renewable capacity, C&I capacity in the development right now. So in terms of other area, we are also very recently got into hydro storage facilities also, where we got some MOU signed with the Maharashtra government, about 5.7 gigawatt. So these are the renewable segment where we are also looking at the hydrogen segments also. We have started a pilot project of blending the hydrogen in our Gorakhpur distribution CGD area of Torrent Gas Limited.
So just speaking on each of these segments individually, with the thermal part, there is some concern in the analyst community that the merchant power sales, which have gone up significantly, as you pointed out, I think from 80 crore it's come to about 140 crore. It may not be sustainable going forward. What's the current run rate of merchant power sales according to you?
The merchant power, it depends on the gas price available, LNG price, I would say. So depending upon the LNG price, we generally do the merchant sale. As far as the gas situation is concerned, it is more or less stable now. It's coming to $10 to $12 kind of a thing. So we are upbeat about the merchant sales also, but it all depends on the availability of gas at affordable price.
All right. Saurav, hi, good morning. Nigel on this side. Well, you've highlighted interest in opportunistic M&A, I think, particularly in the distribution business and renewable energy as well. Have you identified any potential targets that you're looking at?
So in terms of distribution, as you know, we have last year acquired Union Territory of Daman and Diu. So we are performing exceedingly well in Daman and Diu area. Top of it, we have been allocated parallel license in Mandal Becharaji region in Gujarat also. So that also is coming up for it will be operational very soon, I would say. Top of it, we have been there in Dollar season also. Dollar, the special economy investment region also. It's a long-term opportunity for us in Dollar, and it's a very government is trying to develop as a manufacturing hub. So their opportunity will also is a long-term opportunity we are looking at right now. In terms of franchise distribution business, we are awaiting the more franchise to come on the board. Plus, we are awaiting the announcement of the Union Territory of Pondicherry, Daman, Jammu and Kashmir also. The state of Goa is also going for the private elections. We are very keen to participate in all those opportunities.
What is the ballpark number you'll have to spend, sir, for these opportunities that you're looking at?
If you look at the distribution investment, is a gradual investment, it's nothing not like your thermal investment or renewable investment, where you have to invest a very upfront amount. But distribution is a very phased manner. You have to invest every year, and then you have to upgrade the network. So investment in distribution is in a phased manner, not like thermal generation or renewable generations investment.
Okay, all right. Got that. You've said that you want to reach 5 gigawatt of capacity over the next 5 years. You're at about 4.1. I think about 65% of which is gas based. Could you tell us what will be the targeted mode of expansion? I mean, how will you get to this number?
So we have an ambition to reach 5 gigawatt of renewable capacity in next 4-5 years period. Currently, we are at 2 gigawatts right now, including the under development capacity. So we are looking at various area, including the all RE spectrum. We are looking at with solar, wind, hybrid. Also, we are looking at. We are also started looking at the C&I segment also, as well as farm hydro also. So all this segment, we expect that in the next 4-5 years, we are able to reach about 5 gigawatt of renewable capacities. We have started acquiring lands also, as well as we are making applications for the evacuation facility also.
Okay. That tie-up with the government of Maharashtra, you said was the hydro, that's for pump storage, sir?
Pump storage hydro. If you look at the pump storage hydro, there is no storage solution available in India. So there are two kind of solutions available, one is the battery storage as well as one pump storage hydro. Globally, about 90% of the storage facility is available from the pump storage. So battery storage is a bit costly as of now. It's not mature right now at this moment. So pump storage is a well-established, I would say, and a proven technology where we are going to participate in pump storage going forward. So we are in fact in discussion with the other state government like UP, MP, Rajasthan and Gujarat, so that we can take more project in those areas also.
Okay, all right. We'll leave it there. Saurabh, great to have you with us here. Thank you very much for joining us and appreciate you coming on and providing us with all of those details. We'll take a quick commercial break here. With the news of the market still there, I mean, holding the 19,300 kind of level, 19,315, 113 points down. We have the management of Galaxy Surfactants joining in to talk about their quarter and how things are looking for the company. Stay tuned.
Welcome back. The next corporate on our radar is Galaxy Surfactants. The company has saw, across geographies and segments, there was a bit of a weakness. So the top line growth for the company in the current quarter has declined by 18.7%. While there is a volume growth of 7.5%, there was a decline in the EBITDA per ton, and that led to the overall top line contraction of 18 to 19%. Shekhar, the founder and promoter managing director at the company, is with us on the show now. Morning, and thanks for joining in. This is Rima here. So what can you guide on volumes and on the realization, the EBITDA per ton going ahead? What are the key trends that you're observing?
So we have seen approximately 7% volume growth rate. And this is particularly significant because the last 2 years have more or less been flat. And this volume growth has been entirely driven by the robust and buoyant economy in India. We have experienced a double-digit growth in India, whereas consumption has been significantly impacted in the rest of the world, including Africa, Middle East, and Turkey, Europe, and America, due to persistent inflation. So India has been a very, very good growth story. We do see certain green shoots in Europe as well as the Africa, Middle East region. So we are confident that the coming quarters should be similar to the quarter that we have seen now. So we should expect a similar performance to continue for the rest of the year.
All right. Hi, good morning, Mr. Shekhar. So for the year, you're saying that you'll have a volume growth of around 6 to 8%, and also
right.
what could the EBITDA per ton look like? Okay, volume growth you've got 6 to 8% for the year. You're maintaining that. EBITDA per ton, what will it look like for the year?
The EBITDA per ton, as I said, we have not given any sort of guidance with respect to that. However, we have said that we will see or we will aim for an EBITDA growth compared to last year.
Okay. All right. So good morning. So you said rest of the world is still hurting, right? So the high margin specialty surfactant segment is still doing poorly.
Yeah, high margin specialty segment certainly has been doing not as good as it has been, though we have seen that there has been a growth year on year this quarter compared to the last year. Though on quarter we have seen the volumes as good as flat. Fundamentally, what we have seen is the inflation in the developed countries has made the consumers focus only on basic necessities, on mass and mass-produced products, whereas the discretionary expenditure has been significantly impacted. So we do see, we have seen the specialties growing certainly better than compared to last year, and we do expect the consumption to come back as the inflation eases, which we do see happening in Europe. Europe, the prices have moderated compared to what it was last year.
So do you think Europe can report a volume growth at least in Q2, or is it going to be an H2 story? And what about the rest of the regions, right? Africa, Middle East, Turkey, North America. You're talking about green shoots. Can you break them up in individual segments, in the individual geographies? When can we expect a volume growth or a pickup?
We do see some green shoots in Asia other than China, other parts of Asia other than China. We have seen certain green shoots in Europe. Similarly, we were seeing it in Africa, Middle East, and Turkey, but suddenly we have seen a resurge of inflation in Egypt and Turkey in the last week or so. So this volatility is something that can impact consumption, but we would like to remain hopeful and confident.
All right, Mr. Shekhar, give us a couple of numbers then. Value-added products as a percentage of revenues, how much is it now?
When you say value-added products as a percentage of revenue?
You must be having particular amount of your total sales mix that are higher value, right? Which maybe get better margins. Is that the case?
You are talking about specialties. See, specialties have always contributed to approximately 1/3 of our total sales in terms of volume. Sorry, in terms of value. In terms of value, yeah.
Where is that number headed?
Now, that would remain more or less the same going forward, because what has happened in the last 2 years, where people have shifted to the basic necessities, that is mass and masstige products, the performance products have been the category which has been performing. Okay, so when you talk about again this quarter, the performance products have performed, have seen the growth, whereas the specialties have seen a minor decline compared to last year on an overall basis.
Okay, all right. And what is your current capacity utilization levels? I recall that you increased capacity by nearly 50%, in the last 5 years. I think between...
It's in the region of approximately 68 to 70%.
Got it.
All right, Mr. Shekhar, appreciate you joining in, sir. Great speaking with you, and thank you very much once again for joining us here on the program. Well, we are down 100 points on the Nifty, so 19,312 is where we are at. Well, that's a wrap on this edition of Bazaar. From all of us here in the production team, thank you very much for staying with us. Wishing all of you a happy Independence Day once again. Programming continues. Stay with us. We're coming back right after this break.